Hello everyone, thanks for checking out my video. US President Trump's tariff policies have caused massive chaos in the stock market as we saw relentless selling in the past 2 weeks. At one point, the tech-heavy Nasdaq entered the correction territory by declining more than 10% from its record high in December. High-growth tech stocks have faced heavy selling pressure. As of last Friday, Nvidia has erased about $1 trillion in market cap since the AI chip giant hit a record closing high in early January. Tesla plummeted around 45% from its peak, while Palantir plunged more than 30% from its all-time high. With all the chaotic selling going on, S&P 500 and Nasdaq had erased all the election gains. The Trump bump in the stock market has become a Trump dump. When will this sell-off stop? Should investors step in to buy the dip now? Let's discuss them in this video. As always, watch on to find out more. Okay, the S&P 500 rebounded a little last Friday, but despite the small recovery, the index still posted its worst week since September 2024. What's bothering Wall Street and causing all these sell-offs have been pretty evident right now. It's mainly due to the series of trade policies actions by President Trump. I will not go into the details of Trump's tariff policies for two main reasons. Number one, I am not a tariff policies expert. And secondly, these back and forth policies are very fluid and they change almost every other day. But in essence, Trump's tariff policies have sparked worries about future US growth and inflation. And with the constant updates and rapid changes in the policies, there is a lack of clarity on what to expect in the longer term. This is why investors have been dumping shares. All that said, two key events on last Friday had offered some signs of relief for the market. The first is the jobs report. It came in slightly weaker than expected as non-farm payrolls increased by 151,000 jobs in February, less than the estimate of 170,000. In addition, the unemployment rate ticked higher to 4.1%. Okay, I know you might wonder, how is this providing relief for the stock market? I think it depends on how one sees this report. Given how the market has been so negative and has been selling off, any slightly positive news is good news for the market. So, specifically for this jobs report, analysts saw the report as not spectacular but good enough to suggest that the labor market is not weakening dramatically. But what really saved the market on Friday was actually Jerome Powell, a very unlikely savior. I mean, we all know how his words have tanked the market on so many previous occasions, but surprise, he kind of provided some form of relief for the market during his speech on Friday. He basically said that the Fed is not in a hurry to cut interest rates because the US economy continues to be in a good place. So when Powell came out with this calm and reassuring tone, it gave the market an excuse to rally. But here comes the biggest question, will this rally continue into the new week? I will share this in the end thoughts segment, and from technical perspective, there are some things to watch out to, so feel free to skip around based on the timestamps of this video. Alright, in terms of the market outlook, the upcoming week is a CPI week. The market will get the critical inflation report on Wednesday, 12 March, which could further rattle this turbulent stock market. As mentioned earlier, investors have already started to worry about an economic growth slowdown and rising inflation. Therefore, a hot CPI print will likely scare the market. The logic is straightforward. If inflation starts rising even before Trump's tariff policies take full effect, what will happen once all the tariffs are fully implemented? Naturally, this will heighten investors' worries. Just to add, if we get a slowing economic growth and rising inflation, that's called stagflation. It's a toxic combination for almost all assets. Anyway, this upcoming inflation report will be among the last key pieces of data before the Fed next meets on 18 and 19 March. While the central bank is expected to hold the current interest rate level, a hot inflation report could put the Fed in a difficult situation, because you never know, a rate hike could be on the cards. If that happens, the market could be shook. Other things to take note for this week include Thursday PPI and jobless claims, as well as a possible US government shutdown. I know we have heard and talked about this potential shutdown for a number of occasions, but so far it hasn't happened in recent years. However, interestingly, the last government shutdown occurred during President Trump's first term in December 2018. It lasted for 34 days, the longest government shutdown in modern era. Okay, but here's the good news. Government shutdowns haven't really affected the stock market historically speaking. There isn't a strong correlation between market volatility and government shutdown. The reason why I decided to bring this up because Trump is the president right now. He could do a lot of unexpected moves that could shock the market. Meanwhile, on a side note, the earnings season is coming to an end. Some notable names that are reporting this week include Adobe, Oracle, BioNTech, and DocuSign. And oh, one more thing to watch out for the week is the preliminary consumer sentiment survey readings by University of Michigan. This should give us some sensing how worried and negative the consumers are right now with regard to the US economy and inflation. Let's now jump over to the technical analysis section. If I were to use only one sentence to summarize SPY's chart, that would be watch out for the 200 moving average. Okay, end of analysis. I'm kidding. But honestly, that's the gist of it. Above it, it is bullish. Below it, it is bearish. As you can see, SPY has not tested this moving average since October 2023. Back then, SPY fell below it and recovered pretty quickly. So come this week, watch this moving average like a hawk. If SPY breaks below it and doesn't bounce up soon, then my sentiment of the market will turn bearish. By closing below the 200 moving average, which sits at 569, that means SPY would have fallen slightly more than 7% from its peak, and it's very near to the correction territory, which is defined as 10% of the peak. But of course, SPY could do what it did back in October 2023, which was a break below the moving average very briefly and recovered quickly. So to confirm this overall bearish market trend, watch that blue support line that I drew. The level is around 562. This level used to be a resistance and has now turned into a support. If SPY closes below this level, SPY would have fallen about slightly more than 8% from its peak. When this happens, I am of the view that SPY might just continue to grind lower towards the 10% correction territory, which means hitting around 552. I could be wrong. On the other hand, last Friday we saw SPY bounce off the 200 moving average after touching it during intraday. That's slightly positive. If it can continue to do so, then the current pullback is still pretty healthy in my opinion. But here's a big caveat, investors need to stay cautious even if we have a bounce, because in the downtrend market, every bounce will get hit by a sell-off. Therefore, the bulls will minimally want to see SPY closing above the green resistance line at around 583 to have a glimpse of bullish momentum. Honestly, to really resume its bullish momentum or to solidly prove that the bull market is still intact, we need to get above the 50 moving average at 596. It does seem like the bulls have a lot to do. Moving over to Apple, among the Mag 7 stocks, Apple has been the most resilient. But I half suspect it's because of the company's share buyback plan that prevented the share price from plunging like the rest. Anyway, it seems like it's a tug of war between the bulls and the bears as the share price moves sideways between the 50% and 38.2 Fibonacci levels. Interestingly, this area is also where the 50 and 100 moving averages are. Not just that, we also have the blue resistance or support line sitting within this area. Let us give this area a range between 234 to 240. As long as Apple moves within this range, there's nothing to be concerned nor excited about. This is called consolidation. But if Apple breaks below it, then it's slightly bearish. That's when we will likely kiss the low 230 range or sub 230, which means high 220s range. I will only call Apple bearish if it breaks or closes below the 200 moving average at around 226. Ever since we had the huge gap out in May 2024, Apple has never gone close to this moving average at all. So if Apple starts closing below this 200 moving average, it says a lot about the bearish momentum of its share price as well as the broader market. On the other hand, if Apple breaks above that area of 234 to 240, it's only slightly bullish. For Apple to be labeled really bullish, it needs to close above the 61.8 Fibonacci level at 244. But given the current market sentiment, even if Apple does that, I wouldn't be too excited. As you can see, Apple went above 244 for a week previously but plunged about 20 points in the next 1 week. Moving over to Tesla. Wow, Tesla. Can you believe it has fallen to this green support zone that I drew some time ago? Check out this screenshot that I took from this video that I posted on 19 January. Back then, I have already drawn this green rectangular box, and back then Tesla was at 420's range, and at that point, it seems unlikely for Tesla to hit this area. But look at where we are now. Again, if you have found my analysis useful, please help to like and share my videos so that it can reach out to more people. Anyway, last week I specifically mentioned that Tesla was not out of the woods yet, and I said that if Tesla loses the green support zone, we could see 250's range. Check out the chart. Tesla kissed 250.73 during intraday. Okay, that's all the past. What's next? Well, what's next is straightforward. Sorry, give me 30 seconds or you can fast forward this portion. I just wanted to call for some support for this channel. Basically, if you're looking for a new brokerage account, do consider Longbridge. If you sign up using my referral link, I will earn some referral fees. But the users have to deposit at least 2,000 Singapore dollars before I can earn anything. As for yourself, you can earn free Nvidia share by maintaining that $2,000 for 30 days and make 3 separate buy trades. Lastly, there's also additional $18 cash coupon if you sign up using my link. Okay, back to the chart. Pay very special attention to this green support zone, which is around 264 to 272. Tesla briefly broke below it last week but managed to recover. If Tesla starts closing below this green support zone this week, it means a lot more downside to come. I am talking about that gap there, which is around 218 to 238. At that range, the share price would have crashed at least 50%. Honestly, the bears really have to protect this green support area, which used to be a resistance area. If we go below it, Tesla might have difficulty reclaiming it in the short term, as it will become a resistance zone once again. On the other hand, for Tesla to stop its rot, apart from staying above this green zone, which is the minimum, we need a few candles above the 200 moving average, preferably with some volume to show that big buyers are stepping in. Otherwise, it's just retailers picking up this falling knife before another dump. Okay, a few candlesticks above the 200 moving average only mean that Tesla is stopping its rot for the time being. To regain some footing, we need to go above the first Fibonacci level at around 307. And if you were to ask me for the bulls to cheer and stake their claims, we need to see Tesla going above the 50% Fibonacci level or the 50 moving average at around 370. Honestly, this is very unlikely at the moment given the current weak market sentiment and also the negative news on the company and Elon Musk. The share price needs more solid catalysts, whether is it its robotaxi or humanoid robots to push it higher. Otherwise, I am of the view that Tesla will likely move below that in the next few weeks. I'm sorry if you are back holding above 370s or in the 400s range. Let's now move over to Google. For Google, I also have a green support zone on the chart, which is between 160 and 162. But it seems like Google doesn't want to go there, at least for now. Anyway, the chart looks very interesting to me as the share price is right now at a pivotal point. Two things to watch this week. The first is the 176 level, because that's where the 200 moving average and the first Fibonacci level are. I have mentioned a number of times that the 200 moving average has been a very strong support for Google. Even when it fell below it previously, the share price bounced back up shortly, and it seems like Google is trying to do so with that 4 straight green candlesticks. The second thing to watch is the MACD. It is about to have a bullish cross, but not yet. So for this coming week, if Google can reclaim the 200 moving average and is supported by the MACD bullish cross, I am expecting Google to enter the 180s range. At 180s range, pay attention to 182, 186 and 188. The first two are the Fibonacci retracement levels, while 188 is the 50 moving average. If the overall market remains bearish, I would expect some form of resistance at either of these levels. On the other hand, if somehow Google loses momentum and starts falling back down again, then watch out for the recent low of 165.8. If we close below that, I think we can say hello to the green support zone. Alright, let's have a look at Meta's chart. For Meta, should I draw a green box as well? Okay, maybe I should. Here you go. As you can see, Meta briefly touched this green support zone last week, but bounced back up during intraday. Oh, by the way, this support zone is between 596 and around 603. Come this week, watch if Meta will retest this area or not. If it does, this area better hold. If it doesn't, I would expect Meta to continue its decline towards the recent low of 580. If that doesn't hold as well, the probability of hitting the 200 moving average is quite high in my opinion. The 200 moving average currently sits at 566. Okay, not financial advice, I am watching Meta's chart quite closely. I'm still considering whether if I should step in at the green box or 580s range or wait for the 200 moving average to be tested. Or how about buying in tranches at each level? Food for thought. As for the bullish thesis, we need to at least see Meta climbing and closing above 642. That's the Fibonacci level that I mentioned last week. I shared that if it breaks, all hell will break loose, and indeed, the moment Meta lost this level, it fell 40 points and touched 600 level. Anyway, going above 642 is just to stop its rot temporarily. For Meta to hold its footing, we need to get above 660. When that happens, it means Meta is also above the 50 moving average, which is bullish in the current environment as a lot of stocks are below their 50 and 200 moving averages. Alright, let's now have a look at Microsoft. Wow, Microsoft, so close. It was so close to close below this very strong support level at 385. As you can see, we have tested this level on 2 other occasions and the share price bounced off it. And last week we went below this level on one particular day but closed above it by the end of the day. And on 3 other days, the share price went to 385 and 386 level. Basically, Microsoft has been flirting this level on a number of occasions. Will it break this week? I don't know. My style is, let the market decide the direction and we follow shortly after. So if it decides to break and close below this 385 level, then I would say Microsoft is bearish, and I'm not kidding you, we could enter this consolidation area which is in the 360s and 370s range. I don't know about you, but I will likely step in at this area to either buy shares or sell put option. Okay, for the bullish thesis, apart from holding above 385, I think we need to see the share price going above that green line and around 396. To be exact, and for better confirmation, we have to stay above it for at least a week, not like that 2 days where it closed above it but came back down quickly. Anyway, here's one potential saving grace. The MACD is about to have a bullish cross. If that is confirmed this week and if Microsoft closes above 396, I think it's kind of obvious that we can say hello to 400's range again. Last of all, Nvidia. Well, all I can say about Nvidia is that the share price is struggling. I mean, creating higher lows, which is marked by the purple line, trading below both the 250 moving averages, as well as having trouble bouncing off that red downtrend line. All these are bearish signals. So for Nvidia to reverse its bearish trend, simple, do the opposite of what I have just shared. Okay, let's break it down a little more. First and foremost, it needs to get out of that red downtrend channel, but that is just a baby step to stop its rot. For Nvidia boost to have a bit of relief, we need to get above 118 first, but that's not it. Honestly, if we want to reverse this bullish momentum, I would say reclaim that 200 moving average at the very least. By doing so, then it's slightly bullish only. Personally, I think the key test lies at the 50% Fibonacci level at around 130. Like I have always shared, if the main trend is there to stay, which in this case is a downtrend, then the 50% Fibonacci will likely be the highest point Nvidia price will go in the short term. But somehow if the market continues to dump Nvidia shares from this current point and Nvidia gets sucked into that red downtrend channel, wow, can you see that green line? We could be headed towards that. That level is around 96. Alright, let's now jump over to the options trading segment. 6 trades to update again this week. They are all summarized on this screen. The first trade to update is this cash secure put on Nvidia, which was sold on 3rd March Monday with a strike price of 100. The contract will expire on 11 April. The main reason why I opened this trade is the same old reason, overreaction. What happened on 3rd March was that US President Donald Trump confirmed that tariffs from Canada and Mexico will go into effect on 4th March. As a result, the market sold off, with Nvidia's share price plummeted nearly 9%, causing its market cap to fall below $3 trillion. At that point, I was of the view that this huge drop in share price was overdone and the market had overreacted. and so I stepped in to sell a put, which is a slightly bullish move. And then 2 days later on 5th March, I saw that Nvidia bounce off the red downtrend channel and I decided to double in again. As I anticipated a near-term rebound, I opened a new cash secure put on Nvidia with a lower strike price of $95. This contract will also expire on 11 April. But unfortunately, the entire market continued to feel jittery and Nvidia continued to drop the next day. As of last Friday, one trade is sitting on paper gain while the other is on paper lost. So what's the worst case scenario here? The worst outcome for these trades would be getting assigned 100 shares of Nvidia at a $100 strike price and another 100 shares at $95 strike price. But I am totally fine with that. Remember, I always wanted to add more Nvidia shares below 100. In a way, I am getting paid a premium while waiting for that to happen, so why not? Okay, next up, I am gonna combine the next two trades together, which are these Nvidia cash secure puts with $100 and $95 strike prices. Sounds familiar, right? Yup, I basically opened two new Nvidia puts with the same strike prices last week to replace these two that expired on 7 March Friday. Anyway, these two put options were sold on 27th and 30th January. This was the period where DeepSeek was announced, and as always, the market overreacted by dumping Nvidia shares, causing the price to drop more than 15% that week. And so I stepped in to sell that two put contracts. More information can be found in the video link at the top. Shortly after I sold the two contracts, Nvidia rebounded and my strike prices would not breach all the way till the expiration date, which was last Friday. As a result, both contracts expired worthless and I profited around $380 in total. The next trade to update is this cash secure put on Microsoft with 385 strike price, which also expired last Friday 7 March. This contract was sold on 30th January, the day where we saw a 6% plunge in Microsoft's share price after it reported its earnings. Quick recap, overall the results were pretty decent, but investors were disappointed about its revenue forecast and the slower than expected growth in their cloud business. To me, the sell-off didn't quite make sense, and once again I was of the view that the market had overreacted, which prompted me to step in. After I sold the contract, unfortunately, Microsoft went on to decline even more. At one point, my 385 strike price was breached and my put contract was in the money. But fortunately, Microsoft climbed back up and closed above my strike price on the expiration date. As a result, I got to earn the full premium of around $240. Okay, moving on to the final trade, it's this cash secure put on Tesla with a strike price of $315 and was set to expire on 14 March. As you can see, Tesla has been falling like nobody's business, and it's almost impossible for the price to go above $315 on 14 March. And so I decided to roll this put option earlier to avoid early assignment. With that roll, the new expiration date is 25th April with a new strike price of $300. Let's see if the share price can recover by then. Stay tuned to my channel for further updates. Anyway, if you don't know what's rolling a contract, you can check out my options video linked at the top. It's very beginner friendly. Okay, here are some thoughts on the current market situation. Clearly, the market is feeling jittery at the moment, with the fear and greed index signaling extreme fear. This is supported by the so-called fear index VIX, which has surged to its highest level since late last year. There are lots of uncertainties surrounding Trump's tariff policies and their economic impact. This is a major concern. As you may know, the market dislikes uncertainty. They want clarity, which is lacking at the moment. With every new data release, news update or tariff announcement, investors are left questioning, is this just the beginning? Are these tariff plans set in stone? Will there be further negotiations? When will this chaos end? Right now, many investors are torn between seeing this as the buy the dip opportunity in the bull market or the start of a new bear market. This uncertainty is driving a more cautious and risk-off approach. Some investors and institutions are taking profits, holding more cash and moving to the sidelines to reassess the growth outlook. Okay, let's now answer the questions that I posted at the start of this video. Will this sell-off stop? Should investors step in to buy the dip now? Here's my take, as shared in the technical analysis section. From a technical standpoint, so long as S&P 500 can hold that 200 moving average, we could see a short-term relief bounce, which means the sell-off could pause temporarily. But I need to add a huge caveat here. Bets will be off if SPY loses the 200 moving average. And on Wednesday we have the critical CPI data, so don't be surprised if the market bounces on Monday and Tuesday, and if we get a hot inflation print, market could still dump. Basically, my point here is the current trend is leaning bearish, which I believe is pretty obvious for everyone. So far, the attempted rebound from the S&P 500 has been rejected in the current downtrend. In short, we are not seeing any sustained positive momentum. So if we get a bounce this week, don't be too excited. It could be a short-term pause in the sell-off only. Okay, in case you still don't get my answer to the question, will this sell-off stop? The answer is yes, it's possible in the near term solely from technical point of view. The uncertainties surrounding Trump policies and the macro environment remain, so please stay cautious. As for the second question, should investors step in to buy the dip now? I can't speak for you and I can't offer financial advice here. I can only share what I have been doing and are planning to do. If you had watched my recent videos, you will know that I have dipped my toes in for Google and Microsoft, and I will continue to observe the prices and may step in again if they fall further. Another stock that I am looking at is Meta, which has fallen from 740 to 600. That's a 19% discount. It's almost near my entry price. And again, in case I'm not clear enough, yes, I'm buying the dip. I am dipping my toes in and buying in tranches, small tranches in fact. This is to ensure that I have enough bullets or cash to sweep up more shares if the market tanks further or enter a crash territory, which is defined as 20% of its peak. But if it doesn't happen and the market rallies from here, so be it. At least I have stepped in a little bit. Overall, my personal view is that long-term investors should not panic. If you're feeling the anxiety, then don't look at the stock market for a few months, but stay updated on the news. When we have more certainty on Trump's policies, then you come back in. Last of all, whether we like it or not, volatility is here to stay for a while. I have shared this multiple times. In the near term, please expect crazy and scary swings and price actions every week or every other day. As you can see from last Friday, major indexes and stocks were flipping between positive and negative territory. This is the kind of movements we will see very often, and this type of environment or price swings are good only for experienced traders. New traders should stay out from the market, but that's just my personal view, you may disagree. By the way, before I end this video, I just wanted to share that the script of this video is 10 pages long. If you recognize my effort, could you comment effort below and like this video? Thank you very much and I will see you in the next one.